Friday, May 24th, 2024, Maneco 64, home of alternative economics and contrarian views. So we've got Clive on as usual on a Friday. Hi, Clive. How are you?
Hello, good morning, Mario. Lovely spring day here.
Yes, here as well. We had a bit of rain the last few days. At least the garden is a bit greener. And just for the viewers, if you want to connect with Clive Thompson, you can do it on LinkedIn. He's got a lot of followers there, and he'll connect with you and stay in touch. Clive, there's a lot to talk about, but I saw this yesterday. It came out after the market closed, and I'm going to share it with you and the viewers. And it's this story here. Starwood Capital limits redemptions in struggling $10 billion property fund faced with dwindling liquidity and a wave of demands from investors. Sternlicht's investment vehicle blocks the doors. So basically, the fund they've gone from like restricting liquidity rights to by more than 80%. So instead of being able to get 2% a month, you're only going to be able to get 0.33. That's the problem with real estate funds. But the thing that I've found interesting, Clive, was this comment here, facing or this part of the article, facing high redemption requests and dwindling liquidity, SREIT said it would increasingly gate investors because it believes the Federal Reserve will soon cut interest rates, providing for sunnier skies in which it would favor selling property. So what say you about that?
Well, first of all, property is not particularly affected by the very short-term interest rates. It's much more heavily affected by the long-term rates. That is the rates on 10-year bonds, for example, because typically if you have a property that you're going to purchase and you've got a long lease, you're probably going to want to borrow long-term as well. So you know that you have a fixed cost in terms of interest payments over the term of the lease. So first of all, it won't be very much affected by the change in short-term interest rates, if indeed we get one at all. And I see that the main commentators of this are now shifting their opinion as to whether we'll get a cut in interest rates to perhaps just one in December. So that's shifted from 3 times this year, starting in June, to a much later period. So personally, I think that Mr. Powell is very gently moving the goalposts away from cuts in interest rates. And I think he's also moving the target of 2% inflation away because of a comment he made recently in Amsterdam where he said, I haven't given up on 2% inflation yet. Yet is the important word. So for the properties, the problem is if you invest in an illiquid investment and there's more sellers than buyers, well, it's illiquid. They can't sell those underlying investments, and therefore you can't have your money back. And so I don't think that property prices, commercial real estate, is going to be seeing an increase in price if indeed we do get a cut in interest rates.
Yeah, and I mean, there's been talk about commercial real estate for over a year now, how it's a big problem. I think there's almost $1 trillion of loans that in the sector that need to be renewed or something. And you read about all other, there's another guy here I read the other day, Abby Rosen. I'll just share it quickly with the viewers. There's another yeah, real estate, New York real estate royalty. Is his office empire crumbling? Uh, do you think, Clive, this could affect the overall economy if we get a collapse of the commercial real estate? I think these guys are expecting rates to go down, and I don't think, like you, even if the Fed cuts, of course, the longer term rates are more important. And yes, the 10-year yield has come down, but it's still almost at 4.5%. And if the Fed points to doesn't cut this year, I'm sure we could see the 10-year rise again.
Um, so first of all, there's two questions there. Do I think that the real estate prices will recover? And secondly, what's going to happen to the 10-year? So let's start with the 10-year. The government has a growing funding issue because the budget deficit is widening and the interest they're having to pay on the outstanding debt that they have is rising very rapidly. I think it went up over the last 12 months. The interest cost to the Treasury went up by about 35%. And if that continues for some years, it won't be too many years before the interest cost exceeds the totality of their tax revenue. So the problem with a widening deficit, that's where the government is spending more money than it takes in taxes, and with the increasing interest costs on the growing national debt, where it's growing faster than the gross domestic product is growing. The problem with that is that we get to a point where it becomes fairly unmanageable. People are not going to be buying government bonds at the same rate as today, and the rate today is about 4.4%. So I think that perhaps in a year's time we'd be looking at over 5%, maybe 5.5%, and that obviously isn't going to be good for commercial real estate. So I don't think it's going to be positive. I don't think that what's coming is positive for commercial real estate. On the other hand, are we about to suffer a major collapse which will affect the economy? I think the banks and the real estate owners and everybody are trying to manage it down slowly. So what they'd like is to avoid a collapse, or rather a collapse which takes place over several years in slow steps. And if that happens, it should be fairly manageable. But of course, if we suddenly have a loss of confidence and everything falls about and everybody starts to sell things very, very quickly, and that could happen if unexpectedly interest rates will start to rise faster than is being predicted. Yes, well, that might be quite bad for the economy because a lot of the economy does depend on things like the commercial real estate sector, and that will, a collapse in the commercial real estate sector will also impact the housing sector too.
Yeah, I was speaking to someone the other day, and he told me that historically, the 10-year yield is like 2 to 3% on average higher than the Fed funds. Right now, it's below the Fed funds because the curve is inverted. But and that's because I think the market expects the Fed to cut and the Fed funds to come down to like 4 or 3. But if they can't cut rates, and they actually might have to raise rates, i.e., the Fed funds, we could see the longer end of the curve like go down, like the prices of treasuries and yields go up because you can't justify a 4.5% 10-year if the Fed funds don't go down. And so, like you, I agree, we could see 5.5, or even 6 in the 10-year, which would be shocking to a lot of people. But just want to switch over to something I saw here. I think it was yesterday, and I think, and it's from Jamie Dimon. I know a lot of my viewers are very critical, and I'm too, of Jamie Dimon. It's a powerful bank, JP Morgan. But I read this article, and there's a lot of things he says that make sense. He said just because the market is forecasting X, interest rate, all these cuts doesn't mean it's going to happen. And I think he's right. But he said here, and he was actually in Shanghai, Clive, for the JP Morgan Global China Summit, which is interesting, isn't it? We've got the U.S. administration really bashing China, but JP Morgan still goes there. And he says, JP Morgan CEO Jamie Dimon says, can't rule out hard landing for the US. Stagflation will be worst outcome. I think just the fact that he's talking about stagflation is significant. What do you think?
Yeah, well, I think it's a possibility. I'm not putting it very high, but let's just define the word stagflation as opposed to inflation and hyperinflation, for the benefit of some of you. I'm sure many of your viewers do know what this is. So stagflation is when you have a stagnant economy, in other words, a recession, but prices are still rising. So in traditional economics, when you have a recession, prices should fall. But in the modern world, you can have a recession and still have prices rising because the amount of money being printed is increasing all the time. That's stagflation, or stagnating economy with inflation. And hyperinflation, which is the another word we sometimes use, is an inflation rate where the inflation rate is accelerating away at a very high rate, such as we had in the Weimar Republic in Germany and many other countries around the world, depending on the era, ranging from Brazil to Peru to Colombia, Argentina, and Turkey, where they literally keep adding zeros to the banknotes ad infinitum, because the value of the currency is going down so fast, so they have to make bigger and bigger denomination banknotes. So do I think we're going to go into stagflation? The world goes in and out of inflation all the time, although we've had a very long period with no recessions. And obviously the question mark some people are asking is everything different this time? We'll have no more recessions. But one thing's for sure, whether we go into a recession or not, prices are going to keep rising. And that does mean that if we go into recession, we will have stagflation for sure. How likely is it we're going to go into recession? Well, it's going to happen at some point, but right now the signs are not really pointing in that direction. The economy is fairly robust. I'm talking about America here. The jobs data, the official numbers, if you believe them, that is, show that people have got jobs. And by the way, I want to say that I find a lot of things wrong with the jobs data, but I won't go into that. That's a different topic.
Yeah.
But yeah, so I think at the moment it's not imminent, but these things can creep up on us very quickly.
That's right. This is what he said here. Diamond says interest rates could still go up a little bit. I'm not sure if he means, I think he means the Fed funds. And he says, I think inflation is stickier than people think. I think the odds are higher than other people think, mostly because the huge amount of fiscal monetary stimulus still in the system and still maybe driving some of this liquidity. I agree with that. And he says, is the world prepared for higher inflation? And he says, not really. And I think by the world, he means like the stock market, really. And this is what is interesting here. He said, these timing of rate reductions. He said, while market expectations are pretty good, they're not always right. The world said inflation was going to stay at 2 all the time. Then it says it will go to 6. Then it says it's going to 4. It's been 100% wrong almost every single time. Why do you think this time is right? So I thought that was interesting. And now I'll let you, Clive, touch upon an article from Barron's that you saw that seems quite interesting.
Okay, so shall I just bring that up on the shared screen, Mario? Just go there, and I'm not sure how to do this. I'll put it over here and expand it. Give me a second. Right. And that's the one. Share. So you should be able to see that now, Mario.
Yeah, well, I'm gonna just enlarge it a bit.
Yeah.
Okay.
So the article says, should you ditch bonds in your portfolio? The case for buying commodities instead. The key point which comes out of this is that they absolutely think you should. The main reason which they cite right at the end of the article is one related to the huge demand for electrification of the world and infrastructure building. And they basically say that the electrification of the world is driving commodity prices. And by that, I think they mean copper and silver. They don't actually specifically say that those are the two commodities to buy. And I think they do somewhere in the article say energy is another one. But the gist of it is we are going into a period of higher inflation. And they also set out a range of evidence here that over lots of different periods of time that they've measured, owning commodities in a diversified 60/40 portfolio has been a better result than not owning commodities. For example, Bank of America's data show that over the past 80 years, a 60/40 stock commodity portfolio would have returned 10.1% a year on average, compared with 9.3% for bonds. So they're really comparing it with bonds here and say
Oh,
commodities have performed better than bonds. Um, there's a number of, I'll stop the share here.
yeah. And
That
do they mean to get out of all bonds, but take some money out of bonds and keep some bonds and then put it into commodities? Because commodities, I think, is still a very small sector in terms of investment. So even if they were to take out 5% of all the bond assets under, management or whatever, I think it would make a big difference.
Yeah, I mean, there's no absolute amount specified as to what you should have in commodities or bonds. I think the gist of the article is that they think that commodities in the environment we're in, which is one where inflation is likely to go up because government debt is going up, and I'll come back to that in a second, that commodities should be one of the things which is going to do very well, and that's going to be boosted by the new technologies, and a push towards electrification is kind of the conclusion there. But you can see, Mario, that will be doing very well for one of our favorite metals, which is silver.
Yeah.
Um, and maybe just touch on something about the government debt and why that is inflationary. When the government issues debt, and they have to borrow money to pay for the budget deficit, the government gets poorer and someone else gets richer, because the government then spends the money that they've just borrowed. And in doing that, if everybody on the planet is getting richer and the government is forever getting poorer, of course, there's more money on the planet to buy only a limited amount of goods and services. So that does mean that things which are in relatively short supply, like human labor costs, commodities, and so on, they should become over time more expensive as the amount of money on the planet increases. And the money's increasing because the government debt is getting greater. The government's deeper and deeper in debt.
Yeah, and the other thing about the Barron's article that I wanted to tell people, because historically, if Barron puts something on their front page, you can do the opposite. And I don't think this is a front page article, then I'd be worried. But the other thing about commodities and electrification is that I think this move to AI is very yeah, all the semiconductors you need, all the electricity, it's very important as well. And you're going to be needing copper. I think Pierre Lassonde, that I heard him on King World News, he said you need copper, gold, and silver, and a lot of other commodities like even tin. Tin is used to solder together metals in semiconductor circuits. So yeah, that's quite interesting. And I wanted to show you this as well, Clive, and the viewers. Let me just share it. Um, another reason why I think commodities are on a relative basis still very cheap, and this is to equities, but I guess it could apply to bonds as well in a certain way. Just look how undervalued commodities still are to equity. Um, I mean, I think the downside here for commodities versus equities and bonds is quite limited. Is that the way you see it as well, Clive?
Yes, well, I think while we're talking about commodities, let's just give a little bit of an update on BHP's bid for Anglo American. It's a mammoth deal if it ever goes through. It's $30-40 billion the size of the bid. BHP had until yesterday to make their final offer. They managed to get an extension of another week. So they'd already made 3 offers, and all of those 3 offers have been rejected. But the main development which happened yesterday is that Anglo American have finally agreed to actually talk to BHP about the offer. Now, for me, that means I think there's 2 things going on. One, Anglo-American are effectively capitulating here. They're probably going to agree with BHP that the deal can be done at the right price, provided that the right parachutes are in place for the executives. I think that'll be part of the discussions. And you know what I mean by parachutes, Mario. But the other thing it does is gives Anglo-American a little bit more time to court potential suitors, which could include Vale or Vale in Brazil, Rio Tinto, and Glencore, all of whom must be interested in Anglo-American's copper assets. And don't forget that the copper price has been hitting all-time highs week after week recently. I'm not saying it was withholding copper from the market, but it's certainly been going up. And the reason it's going up is for the reason we just discussed, the electrification of the world and more demand for copper. And of course, silver. That's why silver's going up too. So that's the state of play. But I think that one big deal in the commodities sector probably will lead to others, and therefore, over time, we probably will see the commodity companies getting reevaluated a little bit to higher levels. They're all pretty cheap at the moment. They're all very low price-earnings ratio, relatively high yields. I won't go into the details of which ones are where, but it's a sector which is very neglected and unloved at the moment. But I think that might change.
Yeah, I guess it could spill over to the gold and silver miners. Is that what you mean as well?
Yes, I think it'll be the whole sector, and I rather suspect that something like the silver miners, in particular, will do very well. Gold miners for a different reason. The gold miners will do well simply because the world is moving back towards sound money in terms of gold. We're seeing the central banks of the world accumulating gold at a faster rate than they have done since records began, and they're doing that because they know that the current reserve currency in the world can't last in its present state because nothing is being done to balance the books, and therefore they want to have a plan B. And the plan B is if we have to go back to a gold standard, we'd better have a lot of gold.
Interesting you mentioned sound money and gold, because I saw this story here. When was it? I think came out yesterday, I think. Yeah, let's see here, 23rd. And it says IMF calls Zimbabwe switch to gold back ZIG, an important step. So I think ZIG stands for Zimbabwe gold currency. And it's interesting that it's coming from the IMF because historically the IMF has encouraged countries like Zimbabwe and others, or every country, really to hold U.S. treasuries as reserves. But I think it's significant that the IMF says, yeah, that's good, hold your gold. You know, they're not telling them to buy treasuries. So let's just go quickly through here. It says the IMF welcomes Zimbabwe's introduction of a new gold-backed currency as a positive step in its first substantive comment on the ZIG since it was introduced last month. Introduction of ZIG represents an important policy action accompanied by several complementary changes, including monetary exchange rates and fiscal policy measures. A spokesperson for Washington-based lenders said in an email response to questions from Bloomberg. Yeah, and it's interesting. Where is it? It says here, one of the reasons, yeah, this is quite interesting, this comment by the this is what the Zimbabwe central bank has been saying. It says the central bank hopes to get it right this time by promising not to print any more ZIG unless they are backed by reserves. So that's the definition of sound money for me. And
Mario, I got to say,
yep.
I've heard that before, and I can't remember with Argentina or Brazil. But and it's a long memory, maybe 30 or 40 years ago, here in Geneva, and the finance minister of that relevant country, I can't remember whether it's Argentina, but one of the two, came to visit Switzerland and told us that they had a new currency and it was backed 1-to-1 against the dollar, and they would never print another peso unless it was fully backed dollar for dollar. Of course, that didn't last for very long, and that promise failed. So,
Yeah,
do I believe the Zimbabwe government? No.
No, yeah, I think that was probably Argentina. Eventually I think it
I
was
think it was.
1999 or 2000, that whole thing collapsed. And a lot of Argentinians who thought they had dollars lost it. But uh, like you said, though, I think the world is turning a little bit to sound money. Even the IMF, this was from, you probably remember this, this was from January 2023. And just the question is quite significant. Gold is international reserves, a barbarous relic no more. So there you go. Um,
So this Zimbabwe currency will become plausible or more plausible when I see people writing, I went along to my bank with a Zimbabwe ZIG note and exchanged it for an ounce or a bar of gold. Then I'll start to believe it's possibly
yeah,
working.
I'm not sure if it is redeemable. So there you go. Um, what else is going on? I just want to look at the markets because in the last yesterday and Wednesday, we've had a big correction in gold and silver. And I'm gonna share with you and the viewers my screen here with all the prices from IG. So there's spot gold today. It's up $8. The lowest 23.25. And silver, I mean, yesterday we tested that 30 level. We tested again overnight, and now it's at 30.36. Why do you think this is just some profit taking by traders and speculators, and that's how I see it.
Well, I think it's too early to have a victory lap,
No, I
Mario.
agree. No, no,
Even
I'm just
though
saying.
for years we've been talking when silver was below $20, and obviously it's up 50% from there at least. But I think the fact is. It is one of those things. Despite the positive fundamentals, the price of commodities go up and down intraday, week by week, month by month, and sometimes for much longer periods. So it's possible that 30 is the new 20, but I don't know. I would say there's a real risk it could drop a couple of dollars, but I think the long term outlook is much higher than today.
I agree. I'm not, I'm just saying, yeah, I don't think it could be too early. And but I guess we need to take things into perspective as well, I guess, and not get too discouraged because gold started the year, I think, ended 2023 at 2060. So we're still almost $300 higher. And silver as well. I think we start around 24, 25. So it's all perspective. And copper as well. We were talking about copper earlier. That, that has corrected as well. But if you look at copper, Clive, it had been below 4 since for quite a while here, since May
Mhm.
last year. So it has had a big move. So it went through 4, retested 4, and then went up above 5, and now it's just correcting a bit. I think that's what I think it is, a correction. Whether it's over, I don't know. Like you said, it could be early days. Um, what else is there to? I've put a few things here on Twitter. We've gone through that. Oh yeah, this one I wanted to talk about. And I'm not having a go at the strategy, Clive, of diversification, because I think it's
Mm.
not a bad thing. But this guy here, Sven Henrik, the Northman trader, I think he has quite a lot of followers, almost 500,000. And he said yesterday, this is why diversification sucks. You just need to be in the one right stock, and it's Nvidia. Everything's red. Yeah, it was a strange market yesterday. I saw the Dow was down like 600 points. Uh, do, did you see anything there?
Well, Nvidia had results which the market liked, and they went up 10%, and the rest of the market decided to go down. Um, Was that because people were selling everything else to buy Nvidia? All I can tell you, Mario, is that whilst I think Nvidia's got is a great company doing great things, it's not really my cup of tea because it's an overvalued asset. And when they increase the earnings per share, if you're paying 5 or 6 times what it's really worth, you don't get much of that increase. Whereas if you're buying an undervalued asset, i.e. one which is worth far less than its true market value, any increase in earnings per share or any increase in dividend is worth a multiple of that to you. So overvalued assets like that are not really my cup of tea, but I'm not saying that people should run away from them because we're very much in a world where valuation doesn't matter. People are saying, and I don't care what the value of X, Y, and Z is. All I care is that I'm part of the gang. I'm part of the tribe. It's tribal here, where as long as everybody sticks together, we all keep buying it. It's great. But the thing about tribes is when you start to see that the enemy is starting to get bigger than you want to be the first one to run away, not the last man standing. So that's the question. If you're into these Mag 7, as they know, the Magnificent Seven, the hottest stocks on the planet, when the time comes to leave that particular sector, you want to be early leaving it, not late.
Yeah, do you think this also shows that the market, overall market, is not that healthy? Because on the day that you have Nvidia going up almost 10%, everything else is down. You'd think it would be spill over
Um,
into the overall
I,
market.
I think this was largely driven by the changing perception as to where the US interest rates are going. That's a very, very short-term factor. I don't think that interest rates are a very big factor in the long term for stock markets. But of course, it does react to changes in perception. I think the biggest change in perception over the last couple of days, and particularly yesterday, was one where we are now not really looking at any interest rate cuts before December, if at all. And that, that obviously changes people's view who are short, if you're a short-term trader, as to whether you should be holding stocks. But the other side of the coin is we're looking at the US market here, and relative to the rest of the world, the US has become rather more stretched in valuation terms than the rest of the world. I don't think I'd use the word overvalued, but I'd say definitely more fully valued than the rest of the world. But I think that actually, in the long run, stocks are still going to be a very good investment if you are in the right sort of blue chips, because these companies are managed by very, very smart people, highly paid directors, and it's their job to navigate the woes of the world, to navigate the tariffs, to navigate the taxes, navigate the inflation, navigate the interest rates. So in the long run, I think stocks will continue to do very well, but that doesn't mean to say you shouldn't have your insurance policy in terms of commodities and, in particular, gold and silver.
Yeah, and I just wanted to show what the markets did yesterday. So the Dow was down 1.5%, S&P 0.75%, and the Nasdaq. I guess Nasdaq would have been down more if it wasn't for Nvidia. And one last thing I wanted to touch upon, Clive, and it's been off the radar a little bit. The Japanese yen and JGBs. People have been noting that I think it has traded at 1%, the 10-year yield recently, but it's knocking on the door here. And it's the highest level, as you can see, for like 11 years. I personally think this could be a problem for treasuries, for European government bonds, and also gilts, for example, because it's going to drive Japanese savers and investors away from foreign government bonds, maybe more to Japanese government bonds if they're returning more. What's your view on that?
For sure, the carry trade won't be as profitable with interest rates on the 10-year bond now being at 1% than they were when interest rates were at 0.5% or 0.25%. So that does mean that those people who had shorted the Japanese yen bond and bought the US treasuries, that's the carry trade for you, because you make 5% on the treasuries and costs you 0.5% on the Japanese. There won't be as many people doing that now, and that means that there will be unwinding the trade by buying back some of those Japanese bonds and selling some of the US treasuries, or at least there won't be as much support for the US treasuries, if you like, from another angle. So I think that trade will get unwinded, but I mean, I think there's another side to it, and that is what's happening to the yen, because we've got the Japanese central bank engaging in yield curve control to ensure that the yield on these 10-year bonds does not exceed 1%, at least at the moment. And don't forget, they've moved the goalposts. Go back 6 months or 9 months ago, their goal was not to allow that yield to exceed 0.5%, and they've now changed the goal to not to exceed 1%. They could change the goal again, but as long as that goal exists, it means the central bank has to be buying the JGBs, and in doing so, they have to print the Japanese yen. There is another way they could do it, and that is to be selling US treasuries and using the proceeds of the US treasuries to buy yen and therefore buy the JGBs, the Japanese government bonds. So I think the effect on this is, as long as this yield curve control continues to exist in Japan, we're going to see the yen continuing to drift downwards, and we'll continue to see net selling of US treasuries by the Japanese central bank or the government, whoever's holding them. So that's, they historically, they've been a major buyer of US government bonds, and that's one of the supports for government bonds going away. And we can see also that the Chinese are reducing their exposure to bonds. So it's not looking terribly good for the Americans, really, to be honest with you.
Yeah, and here's the dollar yen chart. So when this chart goes up, it means the yen is getting weaker. And we got above 160 back in end of April, or just above 160, and the BOJ intervened, and yes, they brought it down, but you can see that the yen, while the dollar is rising again and the yen's dropping, and I think it's only a matter of time when we break through 160, which shows that, like Clive said, they're printing more yen to keep buying the 10-year JGB and others to keep interest rates under control, because they have such a huge debt. I think the debt to GDP, the national debt, is almost 300% in Japan. So yeah, and like you said, it's going to drive the US will suffer because they're going to be buying less treasuries, and the Chinese as well are buying less treasuries, of course. So Clive, let's wrap up here, and maybe you could tell the viewers, yeah, your some kind of message that you have. What do you think is important right now, short term and maybe also long term?
Well, I think, first of all, one of your favorite topics is gold and silver. I think everybody should have a little bit of gold or silver or both at their home, and keep the majority of it in other forms, either locked away in a safe or somewhere where it's very hard to access. Well, hard for other people to access, not for you personally, because that's kind of an insurance policy against the much higher inflation, which is probably coming. And it's also an insurance policy against the increased government intervention that we're going to see as the CBDC slowly makes its way into our economies. Now, just a small point on the CBDC, I forgot to mention this. Yesterday, the Congress, Republicans, that is, voted that the Federal Reserve should not be allowed to introduce a central bank digital currency into the United States. It was a very partisan vote because the Republicans, who outnumber the Democrats, all voted in favor of stopping the CBDC, whereas all the Democrats voted in favor of allowing the CBDC. Now, that doesn't mean to say the Federal Reserve will not be allowed to do it, because this is just the first vote in Congress, because it now would have to go to the Senate, which is dominated by the Democrats, who were the ones who voted in favor of bringing in the CBDC, and of course, Joe Biden would have to have the final say at the moment, and he, of course, is a Democrat as well. So it's whilst they've had this vote, it's not over and done with, and we'll have to see which way the wind blows. But one of your protections against things like the CBDC and having the freedom to transact in something other than a surveyed currency will be having some gold or silver in your house that you can spend if we have a breakdown in the currency system.
Yeah, I've got here 500 reais, which is the Brazilian silver coin from the 19th century when Brazil was an empire. Not many people know that. And there's the Pedro II. That's 1,001. I mean, I probably wouldn't use that because this is a little more collectible. But yeah, I think everyone should have something outside the system, even if they impose a CBDC. It doesn't mean to say that you can't protect yourself. You just have to be outside the CBDC. You might have to deal in CBDC, unfortunately, but they might put. I think that one of the big things about CBDC is that they want to control what you do. So if they see you buying too much gold and silver with CBDC, they can stop you. If you bought a lot, they could say, oh, you can't buy more gold and silver for another 3 months. That's the kind of thing I see. And that's why I think it's important to be doing it before it happens. So, Clive, thank you for coming on again. I really enjoy chatting with you on a Friday morning, and I wish you a great weekend.
To all your viewers, have a great weekend, and don't forget to give Mario his thumbs up and a like and subscribe.